Hi, I'm Linda Eedes from Foord Asset Management, and I'm joined today by Wim Murray, who is one of the portfolio managers for the Foord Equity Fund. And Wim, today we're talking about constructing South African equity mandates against a rather bleak economic backdrop. I mean, if we consider the last 10 years, South Africa has grown by less than 1% in terms of real GDP terms per year. So companies are really having to swim against the tide in order to grow their earnings. But if I look at the performance of the fund, it's actually done very well over the last few years. So our index in South Africa does include many multinational companies as well. Is the economic backdrop in South Africa one of the reasons why we have a number of global companies in the portfolio?
So we take both a top-down and a bottom-up approach to stock selection and valuations, and we're trying to find opportunities that accurately reflect the various risks under a wide range of outcomes. So while we remain cautious on SA, we are actually still seeing some fairly decent opportunities at play, and that's allowed us to construct a balanced portfolio with both the multinationals and the local listed companies, which is a good place to be.
And so Wim, looking at that local portion of the portfolio, I mean, it doesn't seem that we're going to see significant structural reform over the next few years. How do we go about protecting the portfolio and putting in place companies within the mandate that are protected against the worst case scenario, if you look at the portfolio in its entirety?
So I think the most important starting point is we're looking for companies that will do fairly well even in a muted economic growth scenario. So that's sort of our base case. The best way to go about it is we have roughly 4 buckets we try to fit companies in. We're looking for very high quality companies. Then there's some decent companies, but they've got best-in-class management teams. There's some instances where you're still able to find growth even in a no-growth environment, which is fairly attractive. And then there's some what we would call low beta opportunities where value can be unlocked irrespective of the macroeconomic factors.
So Wim, let's unpack some of those buckets and go through those each in turn. Starting with quality companies. I mean, what does that mean to you? And perhaps you could give us an example of a quality company in the portfolio.
So simply put, we're looking for businesses that can generate a high return on capital, and more importantly, where the earnings we believe is sustainable. So the market positioning is essential in order to form a view of what you think earnings will be going forward, which is reflected in the current share price. So an example of this would be an OUTsurance, where at the moment they're able to generate exceptional returns on equity. And when one unpacks how they're able to do this, through their very high market share in the various insurance lines where they operate, they have superior data, which allows them to price for risk better. And then because of the high market share coupled with the direct insurance model, they're also able to provide the service at a lower cost. So your total all-in cost for them is 20% lower than the closest peer. And this provides a very attractive margin, which is a buffer for them to then deal with all the difficulties that could be thrown at them. So we think that both the earnings profile is very attractive going forward, and we think the high returns they're generating currently will be sustainable.
So Wim, let's move to that next bucket, which is good management teams. I mean, I think, it seems sort of obvious that you'd need a good management team to navigate the difficult environment and all the curveballs that could thrown at company management teams in South Africa. But I suppose the difficult side of it is, how does one measure a good management team? You know, is that something that's quite subjective, or are there tangible measures that we use to assess the quality of the management team?
To an extent, it's subjective. So one needs to take into consideration the environment in which they operate and the quality of the business which they are running. So those two factors do play into it. But there's some objective metrics that one can also look at. So capital allocation would be the most important part of any management team's job. And there you can actually measure whether the returns on incremental capital spent continues to wash its face and create value for shareholders. Then there's simple things like management just being pragmatic about dealing with issues. And it's both in terms of facing challenges head on, executing on the existing strategy, and just being forthright about mistakes being made and how to prevent that happening into the future. Being long-term focused is actually increasingly becoming a competitive advantage. The whole listed space is focused on the next 6 to 12 months of earnings, and you often find that management try to massage the business and the earnings in order to deliver short-term results. And this often comes at the expense of positioning the business for the long term. So in the case of someone like a FirstRand, we find they are exceptional of identifying where the business needs to be 3 to 5 years out. And all their thinking and discussion when we have interaction with them is in terms of where they need to go to generate returns for shareholders. A very good thing to look at in order to see whether management and shareholders' incentives are aligned is actually the remuneration policy. So in FirstRand's instance, they only get rewarded based on divisional performance. So that is where you have control over the factors that you are involved in, and on any returns generated over and above the cost of equity. So if the management teams generate superior returns to shareholders, they get rewarded. So it's certain factors like that that sort of serves as a goalpost in order to evaluate how well the teams have done.
Now, Wim, let's talk about that third bucket that you identified, which is structural growth opportunities. Now, you explained that this is where there's growth occurring, which is not dependent on the economy growing at large. Could you perhaps give us an example of an industry or sector that might be experiencing that, and perhaps a company that we're invested in that is participating in that growth?
Yeah, so we're actually able to find a few of these instances, and they are within our portfolios and have done well. So an example would be a Dis-Chem. So what we have seen over the past decade is the listed players have taken about 20% market share from the unlisted pharmaceutical retailers, which is an incredible amount. And here you just find there's structural shifts within this industry where the buying power, the access to capital, and the ability to appoint good management means that the listed players are able to provide a better service at a lower cost compared to the independent mom-and-pop pharmacies. So we believe this structural shift will continue. There's perhaps another 10 to 15% of market share on the table for them to gain. And the big beneficiaries would be Dis-Chem and Clicks, which are the two listed players. So from a top-line perspective, there's a very positive story that will continue to play out. For Dis-Chem, on a profitability story, we also think they are at an inflection point. So they're busy implementing, restructuring the cost base in order to unlock margins going forward. And we think this will meaningfully drive earnings over the next 3 to 5 years.
And then lastly, Wim, you spoke about, well, it's quite a technical term, sort of your low beta opportunities. Can you explain in simple terms what kind of opportunities would tick that box?
Yeah, so very simply, it's a self-help story. So the outcome for shareholders will be decoupled from the macro factors at play. So an example here would be a Fortress where, very simply put, there's about 22 Rand in tangible net asset value that sits on their balance sheet, while the share is trading at 15 Rand. So there's roughly 50% upside to the current share price in order to get to tangible assets. And importantly, the underlying assets they hold are ones that we actually like. There's a decent retail property portfolio, they've got good logistic assets, and then they have a very liquid, high-quality Nepi Rockcastle stake. So through either unbundling portions of the Nepi or selling down some of the fixed property, they can unlock significant value to shareholders. The key elements at play here would be timing, how quickly they get it done, if at all, and then actually incentivizing the management team to, in effect, shrink their business by unlocking and returning capital to shareholders. If it was not to play out, then at the moment you're sitting on a 9% dividend yield, which we think will increase to roughly 11% over the next 3 years, which is still a fairly decent place to park your money with potential upside should the value unlock happen.
Okay, so that sounds like sort of quite technical opportunities where we've done our homework to understand what value can be unlocked, and we take advantage of that.
Yeah.
Correct. Okay. So lastly, Wim, everybody talks about how low valuations are for SA Inc. type businesses, but sometimes valuations are low for a reason. Of course, everybody's saying that there is a lot of bad news already priced into the valuations. But would you agree that valuations suggest upside from here in terms of prospective returns, or are there situations where valuations are low for good reason and will continue to be so?
Yeah, so investors can pay a very high price for what appears to be optically cheap. And in markets, the devil is often in the detail. So we spoke about the sustainability of earnings. In a tough macro environment, this gets tested to a severe degree. And we think that what appears to be cheap in certain instances will turn out to be overly expensive, and there will be real destruction of capital, shareholders' capital. So it's not a one-for-one or a simple, and that's why we continue to focus on the quality of the business, the quality of the management, or instances where we think there's a very clear road ahead for actually unlocking the value.
Right, Wim. Well, thank you very much. I should remind everyone that our Foord Equity Fund is an SA-only fund, so we don't have a global allocation within that fund. So it's a very useful way to get exposure to the broader South African equity investment opportunity set. Thanks, Wim, for your contribution today, and thanks everyone who's joined us.